When assessing risk under pressure, human decision-making suffers from a severe, well-documented flaw. We rely heavily on subjective feel and surface impressions, allowing implicit biases to override objective data. In the early 2000s, baseball executive Billy Beane exploited this exact weakness. By replacing traditional, intuition-based scouting with strict mathematical analysis, his Oakland Athletics systematically identified and acquired undervalued players. On Wall Street, this exact philosophy is called quantamental investing. It is a strategy that attempts to merge the nuanced, deep-dive evaluation of a human analyst with the relentless, unemotional pattern recognition of a machine. A traditional human analyst might spend hours parsing a single company's quarterly earnings report to gauge financial health. Machine learning algorithm can ingest millions of data points across the entire equities market simultaneously, synthesizing that data into a predictive ranking score. Whether in a baseball stadium or on a trading floor, whoever processes the objective numbers most efficiently wins the unfair game. The greatest theoretical hurdle to algorithmic trading is the efficient market hypothesis, or EMH. This is a financial theory stating that asset prices fully reflect all publicly available information, making it mathematically impossible to consistently beat the market. This presents a clear empirical question. Can predictive algorithms actually mine mundane quarterly financial reports for sustainable alpha, or is the market too perfectly priced? To test this, we can look at a 2021 study published by the IEEE, a leading technical professional organization for engineering and computer science. Researchers isolated 22 years of historical financial data from 70 large-cap stocks within the S&P 100, a major index of leading U.S. companies. The study's roadmap pits three distinct machine learning architectures against each other: feed-forward neural networks, the random forests, and adaptive neural fuzzy inference systems. The goal is to see which of these architectures, if any, can accurately predict long-term performance. If these computational models can consistently outperform the benchmark using only widely available public data, the semi-strong form of the efficient market hypothesis is mathematically broken. The raw material for this experiment is massive. The system ingests data spanning 88 financial quarters, pulled directly from SEC 10Q filings, which are the comprehensive quarterly financial reports publicly traded companies must submit to the government. This table lists the 21 fundamental inputs used by the algorithms, from price to earnings to capital expenditures. But feeding raw dollars into an algorithm is a trap. Models are tricked by macroeconomic drift, where a broad bull market pushes all raw numbers upward. To neutralize this macro illusion, the researchers convert every raw dollar value into a percentage change between consecutive quarters. This strips away the upward time series trend, leaving only the company's isolated performance. The study then sets a highly specific target variable. The machine isn't predicting absolute stock price. It is strictly predicting a stock's quarterly relative return compared to the DJIA, or Dow Jones Industrial Average, a benchmark stock market index. Algorithms are entirely dependent on the quality of their inputs. Eliminating macroeconomic noise is a strict requirement to isolate pure predictive alpha. With the data normalized, the baseline race begins. The pre-processed financials are fed into the three competing models to construct separate portfolios, selecting only the top 20 highest-ranked stocks. This table displays the baseline results. Looking at the mean column, all three unoptimized models picked portfolios that outperformed the benchmark. The clear winner is the random forest model, compounding to an impressive 32.1%. However, these returns conceal a mathematical danger. The standard deviations of these algorithmic portfolios are noticeably higher than the wider market's 3.55, indicating severe volatility. To evaluate whether that risk is mathematically acceptable, quants use a portfolio score. This is a risk-adjusted metric, mathematically similar to a Sharpe ratio, that measures excess return per unit of standard deviation risk. Machine learning models can easily identify short-term winners, but unchecked volatility will destroy compounding returns over a long investment horizon. These models require further refinement. The next step addresses model complexity. Feeding 21 different variables into a neural network based on limited quarterly data risks overfitting, an error where an algorithm memorizes historical noise rather than learning a true predictive pattern. The mathematical solution is dimensionality reduction. The researchers use the random forest algorithm to evaluate and rank every single financial feature by its actual predictive validity. This bar chart ranks the fundamental data, revealing a strict hierarchy. There is a steep drop-off in predictive value after the first few columns on the left. Some metrics matter vastly more than others. Based on this analysis, the researchers ruthlessly distort 15 variables. They isolate only the top 6 highest signal features, anchored by price-to-book ratio, relative return, and price-to-earnings. Applying this pruned dataset yields paradoxical results. Feature selection significantly improves the risk-adjusted returns for the two neural network models, but it actually degrades the performance of the random forest model. Different AI architectures process information in distinct ways. Starving a random forest of broad data weakens its decision trees, but stripping away the noise allows neural networks to become laser-focused on the signal. This presents a complex engineering challenge. How do you capture the hyper-accuracy of the pruned neural networks while maintaining the broad, wide data power of the baseline random forest? The researchers solve this with a final architectural step known as bootstrap aggregation, commonly called ensembling. They construct an AG3 logic gate. A stock is only selected for the final master portfolio if the feed-forward neural network, the fuzzy inference system, and the random forest all independently flag it as a top 20 winner. This chart graphs the relative returns of the AG3 portfolio, providing the visual proof of this consensus model beating the market. The massive orange bars representing the Ensemble portfolio dominate the black universe benchmark quarter over quarter. This table breaks down the numerical breakthrough. Forcing the architectures to agree generates a massive 5.11% mean quarterly return. Over 4.5 years, this strict machine consensus approach compounded to a staggering 137%. There is a mathematical trade-off. Requiring a 3-model consensus dramatically shrinks the number of stocks in the portfolio. Normally, a concentrated portfolio increases volatility, but here, the sheer accuracy of the overlapping picks overwhelms that risk. By forcing diverse algorithms to agree, the system neutralizes human bias and filters out false positives. The result is a massive, mathematically verified edge. We have watched 21 raw fundamental inputs collapse into 6 optimized features, feed through 3 distinct computational architectures, and output a single, high-conviction portfolio. The original Moneyball thesis holds true on Wall Street. When engineered correctly, algorithms process objective corporate fundamentals with far greater accuracy than traditional human heuristics. However, practitioners face a severe real-world constraint: data scarcity. Neural networks crave millions of data points to train effectively, but public companies only publish their full SEC financial disclosures 4 times a year. Developers must also strictly guard against look-ahead bias and data snooping. For a quantimental system to survive in live markets, it must be validated using only the historical data that was physically available to investors at that exact moment in time. The future of value investing does not rely simply on accessing fundamental data. It relies on building the perfect algorithmic consensus engine to interpret it.